Hey there, everyone. Andy here, and this is the podcast where I talk to people who are sometimes and usually my friends who have something to say about wealth building or investing or just finance in general. And today is no exception. I've got Jesse Cramer on the line. Jesse has a blog called The Best Interest, which I am representing right here. If you're listening to this audio only, I'm pointing at my T-shirt. So if you're watching the video, you can see it's green and it's beautiful. And Jesse is one of my first Twitter, like money Twitter finance friends. And he has a wonderful blog, a wonderful podcast, and a just wealth of insight when it comes to personal finance. And he just got married. Congratulations and thanks for joining me, Jesse.
Hey, thank you, Andy. Thanks for the congratulations. We can definitely talk about marriage at some point today. And thank you for having me on. I appreciate the nice introduction. And I'm excited to chit-chat about some cool financial topics today.
Yeah, you're the second guest I've had on my very modest, very new podcast that is much more well-seasoned when it comes to podcasting than I am. So I'm here, as purely an experiment, learning, but having fun. So maybe let's start with that whole marriage thing. Like one of the most bizarre things in my mind when it comes to personal finance and marriage is completely separated finances. But other people really love it. So where do you fall on that spectrum and why?
I think for most people, I think it really makes sense to combine your finances in some way, shape, or form. I mean, the idea of keeping everything 100% separate as if you were not in a relationship whatsoever, I just think in the long run, that's going to cause some sort of problem. And it might not, it might not cause a problem today. And I think that's why a lot of people see no reason why they shouldn't keep finances completely separate. But imagine you have two people, and this is really just a hypothetical, because I'm kind of thinking it up on the fly, but imagine you have two people who are keeping their finances completely separate. They're married. Maybe at some point they're going to have a kid. And now it's like you share this obligation and you need to figure out how to pay for this obligation. I know I'm using like non-human finance talk here, but a child is an obligation that you need to pay for. And doing it jointly makes sense. And then even if you don't have kids, many people don't have kids. What about when you start thinking about retirement? What if one partner has been this diligent saver, they've invested intelligently, and they're ready for retirement at 50? And the other partner is like, I've been spending all my money, I'm going to work until I die. Like, is that the relationship that you want to have? So I just think it makes sense to combine things earlier rather than later. I don't know. What are your thoughts, Andy?
I am obviously, but the opening question there is very loaded question that I asked. I am very for combining finances. I think a lot of people are against it because one, they've been used to that whole thing, or maybe they got married a little bit later, or it's just private. Finance. We don't talk about finance. Or maybe there's some great disparity between how much they earn, and so it's uncomfortable, and they don't want to broach that, whatever. But I am definitely of the mindset that combining is better because. Regardless of what any disparities they are, the sooner you can combine and start getting both of you like running towards the same goals, making combined, beneficial to both parties decisions, like the sooner like everything is going to work better. It's just, I don't know. It's just like you said, it's like if you have different goals and all of a sudden you wake up one day and you're like, oh, whoops, our lives are not aligned like we thought it's just, I don't know. Finance is such as like elephant in the room that if you're not on the same page about it, it's like, it's really tough to wrestle with that elephant.
Do you combine like 100% of your finances in your relationship, Andy? Do you keep like little play money funds separate? Anything like that?
Yeah, so everything is completely combined and everything is agreed upon, but within that combined plan, like we use YNAB, for example, for budgeting, we do set aside like a certain amount each month that we can do whatever we want with no consultation of the other person. So there's that little bit of separation, but it's mutually agreed upon amount separation where we're both fully aware and we can both see what each other buys. So it's full transparency.
Right.
And is that how you do it?
Yeah, more or less. Yeah. We're still actually, we are 5 weeks into our marriage as of today, and 4.5 years into our relationship. So we were on similar financial pages even before we got married, and we're still kind of evolving and figuring out our real kind of pattern and rhythm going forward. But for the most part, like our big goals, we are on the same page. and they are being funded mutually. And our smaller goals, or just the smaller things we want to spend money on, we do so independently, which is pretty similar to what it sounds like you guys have, at least in that you've got your own little side funds that are, it's the Andy fund and it's the Andy's wife fund. And those are independent, but the big major things, you guys are rowing in the same direction.
Yep, exactly. Yeah. So I saw on Twitter that you recently were teaching in a classroom. Was it middle school or elementary? What was that about?
It was middle school. I was really impressed. That was middle school. Yeah.
That's cool. And you were talking about what stocks are and how they work?
So it was this local high school where local middle school, the principal of the middle school is also teaching. I think it's like the one course she teaches because being a principal is too busy for her schedule. And she's teaching a course all about investing in the stock market to these 7th and 8th graders. And it's because the kids are participating in a national stock market competition. I think it's even called the stock market game. They trademarked that. And it's semester long, which in and of itself is interesting. And we can get into that, like playing a semester long stock market game.
Especially in this market.
Exactly. So it's funny. Some of them are they have $100,000 to invest. And they're about halfway, maybe a third of the way through the semester at this point. Most of them are still in 80% cash, which I find ironic. I'm not sure they are intentionally in 80% cash. They're still making up their minds and figuring out what they want to buy. But it ends up being kind of beneficial for them that most of their money was sitting on the sidelines during the last few weeks.
Yeah.
But yeah, they asked me to come in and just give them a little 101 on some stock basics, and then they asked me a lot of questions about the stock market, maybe their individual portfolio, their individual decisions. And it's very interesting, I think, Andy, how the same mistakes that you might see a quote unquote amateur investor making at age 30 or 40, those mistakes are happening in the portfolios of 12 and 13-year-olds. I mean, one of my favorite ones from today was someone was trying to convince me why penny stocks were, in fact, a great investment. Because listen, if a penny stock goes to 2 cents, you've just doubled your money. But if $100 stock, it needs to go up $100 to double your money. And I'm like, all right, time out, buddy, time out.
It's basic math, Jesse. You should get this by now. Doubling is better.
Thing. It is basic math. And it's very easy to understand why that particular mistake gets made,
Yeah. So that was actually today that you did that.
That was this morning. Yeah.
Oh, wow. Okay. I'm even more timely and I didn't even realize it. I didn't look at the timing of the tweet. Okay. That's funny.
Yeah.
So this is our future generation. I mean, were you excited and impressed by their questions? Was there a lot of excitement that they were showing? Like what's your take?
Yeah, it's funny. So I actually had to stop a few minutes in and ask, like, is this exciting material, or are you kind of getting bored by what I'm talking about? Only because I wasn't sure how much knowledge they already had. And also, they're kind of at that age where if you're overly enthusiastic, you're not cool. So everyone was kind of playing down and acting bored. But then once I asked them, like, hey, guys, are you interested? They were really interested in this. I think a lot of them were hyper focused on the stocks that you've heard of, and it's so interesting how that works. Everyone's heard of Netflix, so a lot of them own Netflix. Everyone's heard of Apple, Google, Amazon. You know the usual suspects. Quite a few of them owned ARK, ARKK.
Of course,
it's in the news. It's in the news.
Was there a lot of Tesla?
Yep, Tesla was a big one.
Yeah.
We talked about some cryptocurrency.
Oh.
Yeah, it came up because they were asking about that, and but it was just very interesting, and I didn't quite point it out to them because I'm just not sure they were ready to hear that. But very few of them owned pick your random brick manufacturer. Very few of them owned some boring company that makes chemicals that allow petroleum companies to do their job. Right? They only owned the names that they've heard of.
Yeah.
And that's not usually a good way to invest. There's just no basis behind it,
I mean, on one hand, there is this interesting idea of like, if I use these things and I'm familiar with these companies, I should also own these companies. But also a lot of those same names are the ones that are just like thrashed and trashed on the ups and downs because they are such popular, such hot things, and they get overvalued and overhyped, and then they go back to where maybe they should in the next correction and things. It's kind of a yeah. There's two sides of that coin, I guess.
Right. Like if you own Netflix because you really understand the business fundamentals of Netflix,
Hmm.
and you also happen to use it yourself, and you're like, anecdotally, I understand why customers love Netflix, and I understand it as a business, I'm going to buy it. That's one thing. It's a different thing if you're just like, hey, I'm a 13-year-old kid, I like Netflix, boom, buy the stock. Because
Yeah.
then there really is no fundamental basis for owning it. It's really just it's a feeling, it's a gut feeling.
Yeah. Yes. And feelings and investing, oof, that's a tough combination.
It's very tough.
So speaking of, downturns, corrections,
Mhm.
tough lessons, 2022 has been a bit of a rough patch for all the investors out there. Is this the worst year we've had in a very long time when it comes to investing?
Yeah, I think, and not only is it the worst year, I mean, it's objectively the worst year in the stock market in over a decade. 2020 when COVID hit was bad for a couple months,
Yeah.
and then with fiscal stimulus, everything got magically better.
Hmm.
But the interesting thing is, I mean, not only is 2022 the worst year we've seen in a while for stocks, but it is by far and away the worst year we've seen in many decades for stock bond portfolios. There was this interesting, and I wrote this little article last week that got a little bit of traction just because I went back since 1950 and I compared, let's go to 100% stocks, 100% bonds, all the different increments in between. Let's see how a portfolio would perform year over year. And bonds, traditionally, sure, they're never going to get you the kind of returns that stocks will over the long run. But at the very least, they prevent you from puking, right? They provide some
Hmm.
sort of stability to your portfolio. Even in it was like 2008, I think, the stock market was down 40%. The bond market was actually up 3%. So if you were 60-40, you were only down 24%. If you were 20-80, you were only down like 7%, whatever the numbers are. And that's what bonds should be doing. 2022, right now, the stock market's down 22 or 23% year to date. The bond market is down 15% year to date. There's nowhere to hide when it comes to risk assets. And I mean, some people wouldn't even call bonds a risk asset. Cryptocurrency is a risk asset. Andy, I'm sure you're seeing that the crypto
Hmm.
market's pretty down from all-time highs. It's just there's no good place to hide in 2022.
And to top off these numbers, inflation is at 8 point whatever percent, for the year. And that
Yeah.
has to I mean, this just this weird whirlwind of things that have kind of come together in this interesting mixture. And now we get to see the repercussions. And I think crypto is going to be a very interesting thing to watch because previous crypto bear market was not in this type of economic environment. So this is the first time I've personally been in a crypto bear market where it's also simultaneously taking place during a real recession of the economy mixed with all these other factors. So I'm watching with a lot of interest in the grand experiment that's unfolding. I'm curious what you think about that.
Yeah, I mean, it's tough. I was thinking about it this morning, and I'm trying to put myself in the shoes of what jobs are going to get most disrupted, what sectors, what career types are going to be most disrupted by the recession. And just in general, if we zoom way, way, way out, we just know that people will have less discretionary spending.
Hmm.
And something like, why invest in stocks? Why invest in crypto if you don't have that discretionary spending? And when demand for those assets starts to dry up, well, their price will drop too. I mean, that's at least kind of like the Econ 101 basic theory. Will that happen in practice? I don't know. The economy's kind of way too complex to try to make those very simplistic predictions. But I have kind of put myself in and wondered, okay, are people going to lose their jobs? It's a lot of the kind of financial pundits in the last few weeks have been really coming down on the Federal Reserve, probably rightfully so,
Hmm.
for some of the really strong-handed interest rates hikes we've seen. And those are going to cause people to lose their jobs. There's like no way around it. Companies are going to have a harder time staying afloat. They're going to have to make cuts, jobs lost. It's kind of what the Fed wants to happen. Um, it's just that when you actually have to think about the individuals and the families who that's going to affect, it's a bad thing. And yeah, you're a big cryptocurrency owner, Andy, and I think I can't see demand for cryptocurrency necessarily increasing in the short term, at least because of this.
Oh no, certainly not. I think for whatever they're worth, and they're probably worthless, prediction wise, I think we're probably in for at least a 1 to 2 year wait before any semblance of previous demand comes back for the crypto markets like we saw, the past year,
Hmm.
for example. And yeah, it's really interesting you talking about, this the jobs and stuff that are affected. But you talked about this, like people are saving less. I looked at the numbers recently, and I think COVID numbers were something like $6 trillion or something like that. Wild, and it's down to like 65 billion or something. I can't remember the numbers, but some factor like that of save personal savings on the decline to that extreme. So people spent their savings money. They were excited about spending money, and then now maybe they're reassessing and thinking, "Ooh, I should stop spending. I should start building those savings up again." So all this money is no longer going to be in the market to stimulate the economy. It's
Right.
crazy stuff.
But that is, if that ends up being the case, if right now we're kind of the rubber's hitting the road and individuals are going to stop spending so much because they've depleted all their savings,
Hmm.
that might be a good thing in terms of cooling down the inflation, right? A lot of the inflation was just what is inflation? It's in most basic terms, it's too much money chasing too few goods. So the price
Hmm.
goes up. So if it's the end of that, if the too much money now is not enough money, and it's no longer going to be chasing those goods, maybe we'll start to see some price stability and a return to normalcy as far as inflation goes.
And what is inflation in the US? Well, it's also insane. Insanity. The amount of money you have that printed in just the past couple of years is just it's just mind blowing when you see the scope and scale of it. So
Hmm.
yeah, I think that this is you were hinting at this a little bit. It's like the double edged sword. On one hand, the easy thing, more printing, solve the problems, whatever. But ultimately, you're just kicking, kicking the can down the road or whatever. So you need the rate hikes, you need the corrections, you need some economy rebooting, I guess, and
Hmm.
people to lose jobs and bad things to happen, so they can get into maybe a healthier place. Is that kind of the hope with all this?
As far as I know, that is the hope. It's just it's a really hard thing. It's really hard to thread that needle well because at least from the outside looking in, it seems very easy to overdo it. Whatever analogy you want to use, you're driving a car, and right now we're going way too fast. We are going way too fast. But it's like imagine you just have the touchiest brake in the world, and if you're not careful, you're just going to slam on the brakes, and everyone's going to lurch forward, and that's not pleasant either. And
Hmm.
that's the risk. That's the risk that the Federal Reserve is running right now. I listened to this podcast the other day, and there's a great stat. Something like 22% of U.S. GDP is directly tied to housing. Mainly, it's like home building, right?
Hmm.
Formation of new homes. And when we see interest rates go up, one of the first things that we see affected is the housing market because,
Hmm.
mortgages are higher. If you're a home builder, if you're like one of these big commercial home building companies, you don't want to borrow money at 7% when you could have borrowed money at 3% last year.
Hmm.
So if the Fed is overdoing it, we might not know from the housing market for 6 or 12 or 18 months. And by that time, it's going to be so late in the game that if the Fed then takes their foot off the gas or foot off the brake, whatever, I need to go back to my analogy, but it's going to take another 6 or 12 or 18 months for things to settle out. And that's one of the risks that we're running right now is that we saw the reaction from the COVID stimulus took many, many, many months to actually work its way through the system till we saw inflation. And now some of the response, as far as interest rates hikes, that might take many, many months to work through the system. And if we're overdoing it, it's like this feedback loop where the response from our stimulus isn't coming quick enough for us to actually hone in on the right answer, and we're just going to get this whipsaw back and forth. We'll see.
Yeah. The you just talking about the housing portion of that, and people not being excited to buy houses with these interest rates and stuff.
Hmm.
The data I looked at a couple days ago showed that new buyer traffic for new builds was almost to 2008 levels.
Hmm.
It's gone down that far. I mean, it looks it looks like a crypto chart, looking at the numbers and stuff. But that's just it's wild. Going from 2.6 to 2.8%, on a mortgage to over 7% in the span of basically a year and a half. Yeah, it's
Yeah.
gonna have some effects.
Yeah. And 8 months ago, I want to say, 6 months ago. I mean, not that long ago. It's not that the Fed was neutral and then decided to raise rates. I mean, there was stimulus flowing into the system. I think, the Fed was buying bonds just like 6 or 7 months ago. So they really did an about face really, really quickly. And they
Mhm.
went from pretty stimulant to now just completely choking things down very, very rapidly. And that's what's got a lot of people frustrated too. Is it seems like who's driving this thing? And did you not see this coming? And did you not know that the writing was on the wall?
Mhm.
So yeah, it's a bit of a pickle.
So, what should, like, this is all happening, whether we
Hmm.
like it or not. We are in the middle of it. What should most people be doing right now during this time?
I mean, I don't want to use that cop out of like, personal finance is personal. It depends on your circumstances. But because there are, I think, some
There's,
general
yeah,
answers,
sure.
right? And I think one of them is, listen, if you can afford to curtail your spending, even in the most, minor ways, it's probably going to be to your advantage. Just stuff like, I'm not telling anyone to go on a rice and beans starvation diet, but just really start thinking about your spending more than perhaps you have over the last 12 months.
You
Because
did you did tweet in the past day or two that rice and beans, a little
it
underhyped. Put some
it is
seasoning in there, and it's
delicious. It is delicious, yeah. Um, but I do think that, listen, if you're one of the people we just talked earlier, Andy, about the national savings essentially
Mhm.
being from in the trillions to in the billions, if you're listening to this and you're an average person in the US, your savings have depleted over the last few months. And that's another way of saying you've spent more than you earned.
Mhm.
Okay, that was then, but this is now. Now it's time to earn more than you spend. So tighten up that belt a little bit, spend a little less. If we do enter a recession, you're going to be happy that you did it. If you end up losing your job or losing some of your income, you're going to be happy that you're saving some money right now. So that's one thing that you could do, especially if you're in retirement and you're drawing down your portfolio. Now is a phenomenal time to consider cutting that spending a little bit so that you don't have to pull from your portfolio as much over the next few months, over the next year. One of the most damaging things to portfolios is withdrawing too much money when the market is also down, right? You have to sell more shares to fund your monthly expenses than you otherwise would have during a better market time. So try to be patient, wait for the market to recover. And then if you're growing, if you're trying to still build your portfolio up, it's kind of hard to do both at once, and I might be talking out both sides of my mouth. But the market's down right now. If you can afford to invest a little bit extra, do so. I wouldn't put my monthly expenses at risk. I wouldn't deplete my bank account just to throw money at the market. But if I really felt comfortable with where my savings were at, now would be a time when I'd want to invest more than usual.
Yeah, and I can speak personally that my decision to kind of invest through the last. I'm speaking mostly in terms of cryptocurrency, but I think this would apply across the board. My decision to continue investing through the last bear market has
Hmm.
proven to be a very good one. I'm not saying you should like wait until a bear market happens and then start investing. I invest in the bull market and the bear market, but a lot of people stop when things turn bad. And if you're dollar cost averaging, well, and you're just like having automated buys, well, that seems to me like just forget about it. Just put that out of your mind, and if you can afford to do it, continue on because those purchases on the way down and starting to go on the way back up could be some of your most profitable purchases, and you don't even have to think about them.
Right. It's really interesting that you just hit on something important there, Andy, that a lot of people do decide to stop investing
Yeah.
during bear markets. Like they see it in the news, they see bad news, and they're like, "Well, why would I invest in the S&P 500 right now? It's down 22% on the year." And it strikes me that these people are very concerned about what happens to their dollar tomorrow or next
Hmm.
week or
Yep.
next month. and that timeline is just way too short. Because if you're going to invest in stocks or if you are, say, investing in cryptocurrency, my understanding is that you should have a long-term mindset, that you should believe in the case of cryptocurrency, you should believe in the technology over the long run. And if you're investing in stocks, then you're investing in these companies, you're investing in the US economy over the long run. I'm putting those dollars at risk today, not so that I can have more money tomorrow, so that I can have more money decades from now. So it really is zooming out and taking advantage of the fact that prices are at a discount compared to where they were a year ago. And also the fact that we have this faith, or we have this belief that 10 years from now, we'll be very happy we bought today.
Yeah, the needing the money tomorrow or needing it short term, and that is probably a pretty good telltale sign that that's money you should not be investing if you need it to pay your
Right.
bills next month or something like that.
Right.
Like there's a full spectrum of risk with investments, from what was bonds, but index funds all the way to super speculative things like cryptocurrency.
Mm-hmm.
And some of it you say don't invest unless you're willing to lose the money, but other parts of it might be don't invest if you need that money near term. So the question I guess I have coming out of that is, we are humans are very present-minded creatures. We're very emotional, the here and now. What can you do for me today? Like how do you get past that? How do you become a long-term thinker? Like especially with investing.
It's funny how I think I'm a pretty good long-term thinker when it does come to investing, but in other aspects of my life, I'm a bad long-term thinker, and I wish I was better at long-term thinking. The easy one that I think a lot of people can relate to is like diet and exercise. That my brain is like, eat that cookie, eat
Mm-hmm.
that donut, lay on that couch. I mean, that's pretty short-term thinking.
Mm-hmm.
That's very much just voting for the current moment's pleasure at the cost of long-term health. That's bad. That said, another part of my brain, maybe that's a little bit more math and logical based, has adopted a long-term mindset when it comes to investing. I think one reason why, Andy, is just the amount of reading that I've done on the topic, because I do find it really interesting. I've I've internalized a lot of these truths about the stock market, or at the very least, things that have been true in the past and that we all assume will be true in the future, to the point where it's almost second nature. It's become like an instinct that the stock market is a long-term investment, and that the money I'm putting away now is for 1, 2, 3 decades down the line. So that kind of instinct, it doesn't happen overnight, and I'm not sure everyone listening to this even needs to develop that kind of instinct, because it's a weird word to apply to the scenario. But I do think everyone listening to this, if they want to become a long-term investor, at the very least needs to self-educate enough to become comfortable with the fact that you're going to put thousands of dollars into the market year over year over year. Many times in the future, that portfolio will drop by 20, 30, 40% or more. But in the long run, you're going to be up 6, 7, 8, 9% per year on average, compounded. Balancing all those things in your head, it takes a little bit of convincing, but I think the more you self-educate, the more convinced you become.
Yeah, I think that's really good advice. I think another thing too that I've realized just in my shorter time compared to a lot of people investing is you can't quite put a value or price on experience. Like the
Mm-hmm.
longer you just actually in the market experiencing the things, seeing the portfolio go down, feeling that, getting through that, knowing it's all going to be okay eventually, that is kind of invaluable when it comes to all these things. And it's kind of make or break stuff. And if you can make it, then it gets easier and easier, I feel, at least. And I mean, I'm in the extreme, you know, certain cryptos, down 90%, Bitcoin down, 60%, but honestly, at this point, it's kind of just normal, par for the course kind of stuff for me. But that's just due to experience. And then also combining with that, like education, like knowing that if I've chosen the right things, like this long term, what this long term path kind of looks like, and I can kind of chase that, kind of run towards that.
Right. And this is something interesting. I'm curious what your thoughts are on this, Andy, where you do have this experience now from, correct me if I'm wrong, but a couple crypto bear markets that you've been through. Is this your second, third?
Second, yes.
Second one. So your first one gave you that experience where not only did you read about losing 50% of your portfolio value, you actually went through it. You felt it firsthand, what your portfolio, what it was like. And I think for a lot of stock investors, who are our age or younger, this might be the first serious long-term bear market that they've gone through. And it's mine, I can tell you that much. And on the one hand, I've done a ton of reading over the last 7 or 8 years, to the point where what's going on right now feels very much in family, on par with my expectations. That's fine. And I don't feel that bad about my stock portfolio being down 25%. But I am curious if there will come a point when I'm like, wow, I've read about 40 or 50% declines, and now I'm feeling it for the first time, and it feels bad. I mean, that might happen. And I think for a lot of investors, or at least some people who I've interacted with, they've expressed, I knew a 25% drop could happen, but I don't like it. I don't like the fact that I'm so exposed. Or even maybe the first 10 or 15% drop that happened, they started getting nervous, getting anxious. So I do think the actual bear market gives you experience that reading about it can't. It's kind of, it's that cliche Mike Tyson quote about getting punched in the face, right?
It's true.
Everyone has a plan until they get punched in the face. Well, the bear market, in any risk asset right now is giving you a pretty good jab.
Yeah, I think it's a really good point. It's one thing to know something intellectually and to understand and to feel like you understand it, but to actually see it happen and personally affect you is very different. Yeah, and the Mike Tyson quote is very apt for that. I'm curious what you think about this. A lot of people, when they talk about, especially on the educational side of things, long term, things are down right now. So, but I'm still buying, I'm still hanging on because I know in the future it'll go back up because in the past it's done this, And then you have inevitably on Twitter, you have the people who say things like, or anywhere online, say things like, past results don't guarantee future results or whatever. And I want to hear your thoughts, but I'll tell you really quick that it's annoying to me because I'm like, they absolutely do. That's all we have is like, yeah, technically they don't, but that's literally the only data we have in our lives is what has already happened. The future is unknowable. So if the past stuff isn't something to learn from, well, then we're all screwed. Like, what are your thoughts about that kind of thinking?
I thought you were going to go a different direction, but it's a similar direction. I thought you were going to say, someone inevitably always says, well, what about Japan? Because that's a big one. People always bring up the Japanese stock market that hit this
That's
historic
a fascinating
bubble.
topic too, yeah.
It is. And now, the real quick details for those who don't know, Japan hit this historic stock market bubble combined with a real estate bubble in the late 80s. And then it burst, the market crashed, and more or less it's taken 30 plus years to recover. I think the Japanese stock market is essentially flat compared to where it was 30 years ago.
It looks flat, yeah.
Right. Okay, well, Japan is a different economy than the U.S. It's a smaller economy. It's a more concentrated economy. It's got a much older population. So they've been dealing with some serious demographic issues for the last 30 years. They're not having enough kids. And economies do falter and slow down when the population falters and slow down. I mean, it's not rocket science here. The U.S. is a little different. Our demographics are pretty strong, so I don't see that same kind of fate happening here. I'm actually drafting an article right now, Andy, that's very much on the subject. It's about zero-sum games and positive-sum games. Some people falsely believe that the economy as a whole is a zero-sum game, that in order for America to become wealthy, the rest of the world has to despair and wallow in their poverty. But my argument is go take a tractor, go ride your tractor to ancient Mesopotamia, to some sorghum field, and tell them that the economy hasn't improved over time, right? Go take some vaccines to 16th century Poland, where they're getting ravaged by smallpox, and try to convince them that the economy is a zero-sum game, right? It's not a zero-sum game. It's a well-known fact that the economy's positive sum. We build stuff over time. That's what humans do. We fix problems. We solve things. We take raw resources and combine them into something cool. My point is, getting back to your question, that's why the stock market goes up over time. The businesses that comprise the stock market, they're positive sum. They're trying to build stuff. Some fail, but on average, it's positive sum. So, yeah, the stock market's going to go down. In the long run, though, we have faith it'll go up. If there's ever a point where the stock market goes to zero or is negative in the long run, we will be in a serious economic problem. It could happen, but that's the kind of scenario where you won't be too worried about your portfolio. You'll be worried about whether you know how to make a garden or not,
Yeah.
That kind of thing.
Yeah. Anytime, and I don't really want to talk about politics and stuff, but there is, sentiments and stuff like times were better when, it used to be
Yeah.
better in the old days or whatever. And I think the data is pretty clear that over longer periods of time, at least, things are objectively better now in the world than they were 100 years ago, 500 years ago. I mean, yeah, everything you just said and more. It's like people of those couldn't dream of the things, and oh man, could you imagine a modern person having to go back and like live in those times? There's nothing romantic about it. It'd be hell. It'd be awful.
Oh, totally, totally. I mean, we meaning like our generation, humans today, we are stuck on this hedonic treadmill. We don't even know it, but we have gotten so used to the luxuries around us that we've somehow convinced ourselves that life isn't good. And I think it's a damn shame. And, just think about what you did today, Andy. Think about what I did today. I rode my steel horse 15 miles across the city. I'm talking on this magical cloud internet to you right now, being recorded in a beautiful microphone on a great camera. We're talking about money. Then other people are going to, just some of the things that we do day to day that 50 years ago, even 20 years ago, they would have been impressed. But yeah, let's go 50 years ago. Let's go to what our grandparents were doing. Some of them didn't have running water. Well, most of them had running water. Some of them didn't have electricity. I can tell you that much. Where my grandparents were born, they didn't have electricity. So yeah, I'm not saying everything's perfect. I'm not saying that we don't have progress to make, but things are pretty good.
I agree. Yeah. A few, 100+ years ago, if someone moved more than like 1,000 miles traveled, aside from maybe an occasional once a year, a few times a year letter or something, you might never hear from the person ever again. Yet here we are all the way across, I'm in Texas and you're in New York, right?
Yep.
Yeah,
Rochester.
And we're chatting in real time, having a nice little lovely conversation in our little environmentally controlled capsules here. And it's like life is good. Life is fine,
Yeah, it's funny. I think you just made me think of, I think it's the movie A River Runs Through It, but it takes place in Montana, if I'm getting my details right. And one of the brothers goes to school at Dartmouth, which is in New Hampshire. And it is that kind of thing where it's like, dearest mother, I haven't seen you in 6 years and yada, yada. They're writing these notes back to each other, but like, that's the way life used to be. You take a train for 2 weeks across the country to go to college, and then you don't come back until you're done with college,
Yeah.
So it's funny. It's funny.
That is funny. So I want to get back to the talking a little bit about investing here, and maybe I do want to ask this question in the context of everything currently going on, but also just broadly with investing. I want to know what you have to say about what should someone know about risk, like when it comes to investing. How should people treat risk? How should they think about risk? Obviously, we have very different risk palettes between what we've invested in, so I'm just curious your answer.
Yeah. I think there are two different ways to think about risk. As far as I can tell, that these are kind of the two traditional concepts of risk. The first one is it's the probability that you permanently impair your capital. So if you invest in a stock, you're taking on risk because that company might go out of business and your investment in that stock might go to zero. And once it goes to zero, you have permanently impaired that capital. So that's one way to view risk. Other people view risk, or it's almost like a stand-in for risk, as simple volatility. How much an asset goes up or down in price over short periods of time. And that's not a perfect explanation of risk in my mind, because plenty of things can be volatile, but in the long run are amazing wealth building machines. The stock market's pretty volatile. Over the long run, it's been amazing. If you had just invested in a simple stock index fund, you could have done very well for yourself. But I do think there's a connection between those two definitions, though, because volatility tends to be one of those things that infects our human brains and makes us do stupid stuff, like sell at a market bottom to make ourselves feel better. And that action does impair your capital permanently. So volatility itself, I don't think is a great a synonym for risk, but volatility can make us do things that truly are risky. Like I said, selling at the worst possible time or buying at stupid times. Volatility works both ways. Sometimes volatility means a stock spikes for random or no reasons. You very easily could have bought GameStop at the top. That was a risky behavior because as soon as it crashed, you permanently impaired your capital. So I'm not sure if that really gets at what you were asking about, Andy, but that's kind of how I think about risk. But what are your thoughts on risk as a big cryptocurrency investor?
Yeah, I think you summed it up very nicely, and I think that is there is a duality of how you view risk, and one side it is how do I protect what I have. It is a metric by which I measure how much I could permanently damage my portfolio. On the other hand, it's that view of what can it do for me. So on one hand, it's like, what is it? How's it going to hurt me? And the other hand, it's like, how's it going to help me? And there's, both sides can see the other, but definitely I feel like each side is very concentrated on one portion of it more than the other. And I've certainly have been, to my detriment and also to my benefit, I've been on the side of what can risk do for me, and how can I use it to my advantage? And I think the art there, whether which is very tough to be successful at, I think, and even I'm finding that even with the bit of luck I've had, is how do you either replicate that or how do you maintain that, or how do you find the right things that you can be on the right side of that risk. So I don't know. It's an interesting conversation. I'd like to know maybe how you view, maybe you can talk personally, or maybe you can talk about how you think most people should go about this. But how should you assess your own risk tolerance when you look at getting into a certain investment?
Yeah, that's an awesome question because I don't have a phenomenal answer for it, but I have some ideas. One of the hard things about that question is it gets back to exactly what we were talking about earlier, Andy, where I could give someone a little pop quiz that might help them navigate, find out, discover what their risk tolerance is. But until they're actually thrown into that cage of into the bear pit of a bear market, until they're actually living in it, they might not realize what their true risk tolerance is. So, I mean, an easy one would be like, I could ask someone, hey, if you invested $100,000 with me today, and a year from now, that portfolio was only worth $70,000, but you knew that 10 years from now, it would be worth $200,000. Okay, 100 down to 70 in a year, but a decade later at 200. Would you be okay with that 100 to 70 drop? And it's pretty easy for someone to either say yes or no. But the problem would be if someone says yes, and then we're a year later, and yes, maybe they're down to $70,000, but they're also getting bombarded with headlines. They're seeing my uncle, but not really my uncle, Jim Cramer on TV, losing his mind. They kind of get infected with this pessimism, and they might realize in real time that their risk tolerance isn't what they thought it was. So that's really the hard part about answering that question. I think the best that we can do is try to give people some of those quote unquote pop quizzes and think about it intellectually, in your words, Andy. But it is really nice and convenient when the rubber meets the road and we actually live through some risky times or some volatile times, because that's when we can really test each other and understand what our risk tolerances are.
Yeah, I think that's good. I think that is similar to what my answer would be, with the
Yeah.
combination of like modeling it out and going through the scenarios and having some semblance of a idea of how you're looking at the next 5 years, 10 years, whatever, and what you're okay with your portfolio doing, but then modifying that upon actually entering into positions and seeing what actually does happen and stuff, because you might think, oh, I'm okay with it going from 100,000 down to 30,000 as long as it goes up to 500,000 5 years later. Higher risk thing, like
Mm-hmm.
crypto or something. But then you actually watch. Hopefully, you don't do it with 100,000. You start smaller, but you watch your $100 go down to $30 or something, and then you go, maybe I was wrong. Maybe I'm not cut out for this. I can't deal with this, and this isn't even a big amount of money. But I think you have to um, maybe start with a conservative plan and then do smaller experiments with the riskier stuff that you think you have an appetite for. So you actually do get started, you don't wait, but you also realize that you're not in any big like rush. If you don't figure it all out like on day one, it's not the end of the world, you know? So it's like, it's this weird
Yeah.
combination of like, yeah, start as early as you can because the earlier you start, the more compounding, works in your favor. But also you need to give yourself breathing room just in case some of your plans aren't your final plans, you know?
Yeah. I mean, I'm interested to hear your experience with this, but when you first put in those first few $1,000 into Bitcoin or into the stock market, whatever your early investments were, did you find that having skin in the game motivated you to learn more and more and more?
Oh yeah, certainly, definitely. Yeah,
Yeah.
and
Because I
you'll be
mean,
very pleased to know that I think my very first actual investment was opening a Roth IRA
was it? Okay.
and doing a at the time it was a target date fund with Vanguard. So I
Yeah.
actually I did that before I got into crypto. But yeah, skin in the game helped.
Right. And I think that's probably true for anyone listening that you start small. Not only will you test your own risk tolerance through those
Hmm.
small experiments, but you'll also feel that motivation to be like, whoa, I've got $5,000 in this account. That's some serious money. It's enough to care. And because I care, I'm gonna stop in the middle of my day and read that article about the stock market. I'm gonna try to learn. I'm gonna go home at night. I'm gonna pull up Oh Hi Andy on YouTube, learn some about cryptocurrency. It was very true for me that when I was in my young 20s and I realized one day, like, whoa, I've got $25,000 in my 401k. Maybe I should learn more about this. And
Hmm.
that little seed of an idea grew to eventually into, this conversation today and all the stuff I've been doing over the past few years. Um, so I do think you can test your own risk tolerance. You can learn a lot by those small experiments. I like that idea.
Yeah, yeah, I think that's good. So I already mentioned this, I alluded to this, but obviously we both have fairly different risk tolerance palettes.
Hmm.
I'm perfectly happy to have a majority of my money sitting in something like Bitcoin, and you would, I think would feel much more comfortable having the majority sitting in an index fund or a good ETF or something. So, my question then is, given that disparity, what do you have in your portfolio that you would say is more akin to Andy style? What do you have in your portfolio that maybe will get you to some of those numbers faster, potentially those asymmetric bets? Do you have any? What are they?
I do own very small concentrations, very small amounts. I own a little bit of Ethereum and Bitcoin inside of a mutual funds owned is it the
Mm-hmm.
Grayscale,
Grayscale. Yep. Hmm.
Grayscale.
GBTC.
Exactly, some GBTC and some whatever the Grayscale Ethereum trust is.
Hmm.
So, but the way I approach that, Andy, and this is kind of I've heard this metaphor before, where it's kind of like you have your core and then some satellites around the core, where 95% of my money, probably even more, it's probably more like 97% of my money, is in my core portfolio, which is some low cost, stock ETFs, a very small sliver in bonds, and a small sliver in some alternative assets, which are like timberland and farmland, a reinsurance fund. And that's kind of how I view my real long term money right there. But I am going to I'm cool with taking some risks. But for me, it's all about what I would call right sizing those bets. So if I have a bet that is 10 times more likely to go to a million, but also 10 times more likely to go to zero, I'm probably going to make that bet 10 times smaller than what some of my other investments are. And I think even if you were just to build a portfolio like purely of stocks, you would want some of your more speculative stocks to be smaller positions in that portfolio, because that's you kind of get this evening out on the risk return spectrum if you do it that way. So the only part, if I were to say put half my money into cryptocurrency, the part that would make me nervous is having that big of a allocation in such a volatile, risky asset that it would kind of it probably would affect how I sleep at night, to be honest with you. And so that's one of my easy metrics of merit to let me know that I'm probably overdoing it.
Well, I think even 1% of total portfolio in something speculative is a big win.
Hmm.
And maybe it, excites, anybody who's able to actually do that and goes forward with it, and they pick the right thing with that 1%. If it does perform extremely well, and if maybe it, opens their appetite a little bit more to other things, or they just go, that was a good decision. I'm happy I did that. And if it goes to zero, I feel like in certain if you take 100% of your portfolio, you put 1% in something potentially asymmetric you really think could be that thing. If it goes to zero, you lose 1% of your portfolio. No harm done. But I really like that people who are even more traditional having at least a bit of open mindedness to even a little teeny sliver to something that could potentially be an outsized performer.
Yeah, I mean that's the thing. You know this 100 times better, a million times better than me, Andy. That there is real utility in the blockchain.
Oh yeah.
There's real utility there. And when I think of utility, I go back to the thing I was talking about earlier: positive sum games. That's economic value. That's positive sum. And I like investing in things that are positive sum. So, how will utility in the blockchain play out in the long run? I'm not really sure. That's the thing that I'm not an expert on at all. But I know that right now, the two leading candidates are somehow through the Bitcoin blockchain and somehow through the Ethereum blockchain. So, those are the two cryptocurrency technologies that I've chosen to invest in.
It's like asking in 1992, what are the long-term full implications of the internet? It's like,
Right,
ooh.
right.
I have a lot of great guesses, and I'm hoping I'm putting my money in some of the right places.
Hmm.
But time will tell. The next 10 to
Right,
20 years will be very telling of what actually cryptocurrency turns into, or what it doesn't turn into. Who
right,
who knows?
right.
It's
Well, speaking of, I'm actually curious on this topic if we can go one step deeper. What kind of diversification do you have in the crypto space, Andy? I'm just, if because essentially you are kind of investing in, say, the early stages of the internet. Who knows where the real winners are going to come? I mean, have you kind of dabbled into some smaller bets within the crypto space?
oh yeah, I have lots. One of the things I've learned about crypto is diversification is key when you talk about things other than Bitcoin or even Ethereum. In that, 99% of what was like the hot stuff in 2017 and even the first half of 2018 doesn't have any meaningful effect on the market or even exist today. And I've
Hmm.
seen the same thing with this recent bull run. Lots and lots of bets went to zero. But I try to be as conservative as I can within crypto. I have a spectrum of investing within the space, and so far, and who knows what the future holds. I might be completely wrong, but so far, all my wins have so far outweighed my losses that it's been a very effective strategy to kind of be broad spectrumed, shore up the wins when I get them. I mostly convert that stuff into Bitcoin, which is my most conviction based holding in crypto, and then just kind of rinse repeat, knowing that most small stuff is all purely, it's like penny stock stuff. It's just purely speculative. Purely retail invest based. It's gonna pop. These bubbles pop left, right, and center. Um, but while I never fully liquidate any of those smaller things, I just, will sometimes liquidate 90% of them into Bitcoin or whatever, because I know that, how do you pick, which one will exist in a decade or not? Which, Ethereum, once upon a time, you could buy an ICO of Ethereum for $1 per Ethereum. And then
Hmm.
in 2014. And here we are in 2022, and it's still over $1,200. So it's like, how do you pick those things? And you can't. So you have to do your best judgment, exercise best judgment, and then do lots of bets in the space if you want to have any semblance. But it's a ton of work, and it's not for
Yeah,
everybody, and
yeah.
it's you can just as easily lose everything if you do it, not the best way, and even I haven't done it the most efficient way. So it's a very tough thing to answer. I just know that what I've done has worked for me, and so that's my plan is working so far, and it's my full choice to, at a moment's notice, completely rearrange my plan as I see fit for my next year, 2 years, or whatever.
Right. I mean, that's how venture capital firms do the same. It's very, very similar that they're investing in startup companies. You're investing in startup coins or startup blockchain projects.
Hmm.
With the startup companies, even the ones that look amazing on paper, nothing's guaranteed. They all individually have pretty low probabilities of success, which is why you invest in many, many, many of them from your venture capital fund, because maybe you'll invest in 100 startups, 90 will go out of business, nine of them are decent companies, and one of them's Uber. And
Yep.
that one bet that's Uber, that will just make up for the 90 that went out of business.
Hmm.
So that seems to be the way that, like, they do it out in Silicon Valley. And if I were doing what you're doing, Andy, I would have that same exact mindset that you have for that.
Yeah, on my channel, I often call myself the poor man's venture capitalist because I'm not investing millions of dollars, per bet
Yeah,
or whatever, but
yeah.
that's how I approach it. And that is something that a lot of people can't stomach, and that's okay. But also something is really important to note that I try to explain when I talk about this stuff is, um, if all my bets I've made in crypto are wrong and my
Hmm.
current portfolio goes to zero, I am quite confident with the things I'm building online, all my multiple businesses, my multiple income streams. I can rebuild from zero to where I'm at now in a very short amount of time. And so if you don't have that confidence, you don't have an ability to, catch up again or rebuild it in a meaningful amount of time. So if that loss is going to really hurt your future, that's where it gets a little dicey for me. And I'm much more conservative in my recommendations. Not that I recommend anything financially, but it's such a big, broad spectrum, and everyone's so different. That's what's fascinating about it.
Yeah. Well, that's a really good point though that you make. Like, you do have this very diverse skill set, and speaking of, like, proving yourself, like we were talking earlier about proving your own risk tolerance, you have a proven track record as an entrepreneur, be it in person, like with some of your real world businesses, be it online with your YouTube channel, your ability to create a large following on social media. And I do think that has to play into your confidence when it comes to these investment choices, that you know that you have cash flow backing you up if you need to rely on that. And when I'm working with people who are talking about investing, that's a really important thing to discuss. Is like, what's your cash flow like? Do you have the ability? Do you have the timeline? Do you have the skill set to make up for investment losses? If someone's entering retirement, the answer there is, boy, I kind of want the answer to be no. I
Yeah.
don't want to go back to work. And that's why someone entering retirement, we would tend to take a much more conservative investment approach. Are you familiar with J.L. Collins?
I'm
The
not.
He is the author of A Simple Path to Wealth, or The
Oh,
Simple Path to Wealth.
I'm not. I have not
He's
read it, but yeah, I've seen the
Yeah,
book. Yeah. Hmm.
yeah, and he's a big fire. A lot of people in the fire community follow him, but he has, not to everybody, but he's indicated before in his book. He's like, listen, you should consider being 100% VTSAX, 100% stock market investor full time. Just, this whole idea of going conservative into bonds when you retire, don't do that. And later on in the book, he does say, well, listen, if you want some bonds, here's what I would recommend. And I would understand why. But that example, that particular example where he says, nope, nope, all stocks all the time, makes me cringe a little bit, because in my mind, that's a way to permanently impair your capital in some scenarios when you're retired, let's say, in a way that I really wouldn't want to do that. But that's neither here nor there.
Yeah, it's a very good point to bring up. Cash flow, income streams. If you're somebody who has your household has a single 9 to 5 job income coming into it, and if you budget extremely tightly and you do everything right, you dot all your I's, cross all your T's, and you're able to invest 10% of your take home income, which is more than many people can even do. In that scenario, maybe you shouldn't take your 10% per month and put it in like crazy, risky, highly speculative stuff. Now, if you can do some side hustles and do some other things, and now all of a sudden the money you bring in per month, you can invest like 40 or 50% or some of these big numbers. Well, things change. Like it's a constantly shifting, finish line. It's like you
Right.
have to you have to change the goalposts depending on whatever situation you're in. Otherwise, yeah, you're either setting yourself up for a guaranteed failure, or you're being way too conservative and you do something you shouldn't even. There's a full end of the spectrum. Yeah, and it varies widely depending on the person.
Yeah. Yeah. And if it makes someone feel better, I like this concept that I've heard of called, some people call it bucketing your money or just mental accounting. And long story short, you think of different timelines in your mind. Usually there's a short, a medium, and a long, or two short timelines and then a medium. So the first one might be the next 6 months. And the next timeline might be from 6 months to 2 years, then from 2 years to 5 years, and then 5 years plus, something like that. And with each of those buckets, you have to say to yourself, okay, this money that I'm investing, is it for the short bucket? Is it for one of the medium buckets? Is it for the long bucket? And then you invest, you take enough risk appropriate with whatever timeline is there. So for me, I've got probably 6 or 8 months worth of spending in my savings account. That's my short-term bucket. And it's in a savings account. It's making 2%. It's nothing, but it's not an investment. It's there because it helps me sleep at night knowing that that short-term money is there. The money that I'm putting risk in the stock market, the money that I'm putting at risk in those two cryptocurrency mutual funds that I talked about earlier, that's all long-term money. And I know that I have the cash flow. If something were to happen to that money, I have the cash flow that's going to support my lifestyle in 5 years. I'm not worried about that. So that kind of balance might help some people think about, when to take risks with their investments versus when not to.
Yeah, I think that's really good. You just mentioned fire and stuff. I did have this question that I really wanted to ask you, which, one, could you describe it just very briefly to everybody if they don't know what it is? But two, is the 4% rule overrated? Is it outdated? Is it done?
Good question. So the FIRE movement, right? Financial independence, retiring early, is this pretty cool idea that if you save a good amount of money, if you curtail your spending and live pretty frugally, then at a well earlier than normal age, you can afford to retire and live off of your investment growth for the rest of your life. I think that's the FIRE movement in a nutshell.
Yep.
And one thing that people tend to use in the FIRE community is the so-called 4% rule, which says that you can indefinitely pull 4% out of your investment portfolio per year, live off that 4% as your annual spending, and your portfolio will grow enough to always make up for that 4%. And so you're indefinitely living off of 4%. This topic, that rule, has been looked at, tested, pulled apart, put back together so many times. Personally, I'm less concerned about it being like out of date as I am just being, I'm concerned about people actually understanding how it was created, if that makes sense, Andy. And what I mean by that is the 4% rule was originally created for 30-year retirements. It was originally created assuming a 50-50 stock bond portfolio over those 30 years. It was 97% effective or something like that in the historical back tests, meaning they went back in stock and bond market history and they said, would the 4% rule have worked for a retiree? Basically, it always works. A couple times it would have failed, but there's some little minute rules there around the 4% rule where I'll read someone's financial independence blog and they'll be like, well, I retired at 32. I'm holding 100% stocks and I'm using the 4% rule. And I want to be like, wait, time out. 4% rule was created for a 30-year retirement. It was created assuming 50-50 stocks and bonds, not 100% stocks. Because as soon as you deviate from what the assumptions were that went into the 4% rule, you should be rethinking whether or not it's appropriate for you.
Yeah. Cool. Yeah, I think that's a great answer. I've looked into it here and there, and I think, there's so many variables that go into whether or not that's an accurate strategy for you. I like using the 4% rule or 3% rule or 2% rule, whatever percent you want to pull, whatever, as a kind of nice to have. But I want to be so far above those numbers and what I actually retire with when I retire early, but then I don't actually retire early. I keep doing things that are fun that still make me money
Right.
and whatever. So I
Right.
indefinitely expand that time forever and ever. But for me personally, and I think a lot of people maybe would relate to this, I just want the option to say, I'm not going to work this year or something, or like work is optional at some point if you really want it to be. You have some rule like that to fall back on that you can follow yourself if it fits your whatever. But I think it's maybe, you brought up a lot of good points, why it's maybe not smart to just blindly jump on it because that's what everybody in a certain community says is the way to go about this. There's so many minute implications to even something that is, across the board agreed on is like the standard thing for,
Yeah.
early retirement or whatever.
Yeah. I think what it really comes down to, and it's such an interesting dichotomy and conundrum, where there's this really cool stat that proves that most retirement planning is way too conservative. Way too conservative. And the stat is that for every one person who runs out of money in retirement, about 4 people end up with more money when they die than when they retired.
Wow.
Does that make sense how I
Yeah.
explained that? So you're much more likely to have more money when you died than when you retired versus running out of money in the first place. And that's simply a function of too much conservatism being built into retirements. And I'll just end it at that. But on the other side, if you run out of money in your retirement, that is a really, can I swear on this podcast? That is a
Sure.
really sucky, shitty thing to go through. That I would hate to go through that. And when it comes to like people who I work with here, that's not what I want to happen to them.
Yep.
So it's like, how do you kind of find this middle ground where someone's enjoying the money that they've earned and they're actually spending down their portfolio, but also that you have enough conservatism that they don't run out of money? That's the 2 things we're trying to balance here when it comes to the 4% rule, the 5% rule, the 3% rule, whatever it is. But as listeners are kind of thinking about their retirement planning, trying to plan ahead, those are the 2 things that you want to think about. You really don't want to run out of money before you die, but you also don't want to bake in so much conservatism that you worked a decade too much and now you're dying with all this money. Like, what's the point of that?
Yep. You heard it here first. Jesse says, spend your damn money, but just not too much of it, just enough. I'm curious, what is the worst, most common personal finance advice you've seen?
Ooh, boy, that's a really good one. The worst advice that's also really common. I feel like I should have a list of like 100 things, and I probably do. But it's like, what's jumping off the page at me? I mean, here's one. There's this whole movement in the insurance industry that they're trying to say that 401ks are a scam. That's an interesting one. I don't know if you've heard that. Essentially, what they're saying is like, you're loaning your money to the government, and you don't get access to your money for 20, 30 years. And there really is no tax benefit because in the long run, you have to pay your taxes anyway. And I hate to, poo-poo what someone else is trying to do to make a dollar. But what it really ends up, it's anti-401k marketing in order to sell life insurance policies. So that's a pretty bad one.
Yep.
There's some people out there, it's not too popular, but there are some people out there who are extremely anti-budgeting. Just where they're saying, yeah, they just say, listen, like you don't need a budget at all. It's just way too much work, and it's people hate budgeting, so why even do it in the first place? And I've long ago, you use You Need a Budget, Andy. I use You Need a Budget. It takes a little bit of effort, and if you're a nerd for this stuff, you enjoy You Need a Budget. But if you're not a nerd, then I don't think it's the right tool for you. That said, I think there's another tool out there that you should be using that is much simpler, but also semi-effective at budgeting. So that's some other popular advice or semi-popular advice I've heard. You don't need a budget. I think it's just crap.
Yeah, I would agree with that. I do think, like I use YNAB. And I like it a lot, and it was very helpful for us to get our finances on track and stuff. But it no longer dictates financial decisions like it used to, as we've scaled up income and certain things. It's still, I mean, it gives us rules and things. But if you are in a place where things are not looking so good financially, and you don't have a budget, then you have no clarity into what's going on or where the money is actually going or anything like that. And it's like personal finance 101. It's like know where the money is going, so then you can start making better decisions about how you're going to, spend it going forward.
Totally. I mean, good investing, we've spent most of today talking about investing, but good investing flows from good personal finance.
Yep.
Meaning, you and I, Andy, we have a surplus of money every month that we can use to invest. The reason why is because we have budgets that are really accurate and that let us know how much we can afford to invest. I'm just thinking of some really dear people in my life who, in various times over the last few years, have made some sort of either big mistake that was a result of them not budgeting, or simply, admitted to me at some point, like, man, I'm kind of stressed out about my finances. And I think one of the reasons why is I don't know where my money is. I don't know where it's going. The end of the month comes and I get that credit. I can't believe we spent that much on these things. And I just say, I totally get it. It's really common. One thing that I think would really help you is a budget.
Yeah, I think that what you just said is like one of my favorite things about that a budget provides somebody is if you do it right and you check in regularly on your budget, you're going to see the credit card charges come in. You're going to see these things, and then you're confronted with them before the bill hits. Maybe you in time to maybe slow that down before the end of the month, and like it just gives you that overview of like what's currently happening, and you can make better decisions in the short term and and for the long term. But short term is so important when you like spending it, eating out and doing this, doing that, whatever. It just gives you that insight and clarity that you can't get basically anywhere else.
Yeah. And I don't know if you do it this way, Andy. So you need a budget, YNAB. You can connect your credit card to the app itself and have everything kind of filed automatically. I don't take advantage of that. I don't know. Do you take advantage of that?
I have everything automatically connected to where it brings in all the transactions automatically, but I have to manually file them.
Gotcha.
So it gives me a big thing. It says, these are all the new transactions, and I have to put them places manually. So I don't want to have to like do the entire manual transaction myself, but I do want to manually say, I'm putting this here and I'm intentional. And that way I go, oh, whoops, eating out a little too much this month. Okay.
Exactly.
Stuff like that. Yeah.
Exactly. So I'm very similar. Maybe I do a little extra work that I probably don't need to do now that I hear the way you describe that. Maybe I'll start doing it that way. But either way, I want to have a bit of a hands-on touch, just like you do, so that I spent the money on Saturday, and then I do my reconciling sometime midweek. And now it's 4 days later after I spent the money, and I have to face that fact again. Oh, I spent $150 at REI on camping gear. I didn't really have that budgeted. When I was there in the store, I was like, oh, I'm pretty excited about this. But now it's 4 days later, and I kind of have to face my lesson, eat my medicine, take my medicine. I think that's really effective in my budgeting mindset, and it sounds like the same for you.
That's why I love YNAB. I love doing the manual thing because then you're confronted with those decisions you've made and you have to like think about them and the repercussions for, or the good decisions too. And you get to see both sides. And why I don't love fully automatic or tools like, I mean, I haven't looked at it in forever, but Mint, once upon a time, you could like connect everything and automatically filed things. And you like after it all happened, after the month happened, you look back in the month and go, oh, here's what I spent there. Or there's like, you look at things that have already happened. Whereas YNAB is a little bit more in the moment. You're seeing things as they play out, which you can do with Mint and other tools. But it's when everything's automatic and automated and sorted for you, it's tougher to make those decisions and things when you're not in the thick of it, when you just see it retroactively. And then if you're really smart and wise and a go-getter and motivated, you can look at those decisions retroactively and then make better ones in the future. But I feel like for most people, it's better if like in the moment you're having to file things away or whatever, and then you have to go, oh, should I do this next month? The answer is probably no.
Mm-hmm. Right.
So one last question for you, Jesse, and then I'll let you go. And this is one it fascinates me, and I try to ask a lot of people this question. But what's your best advice for a 20-year-old, or could be specifically, what is your best advice for 20-year-old Jesse?
Ooh. And is this financial advice, or is this just any sort of life advice?
Whatever you think a 20-year-old most needs to hear financially or life, or whatever 20-year-old Jesse just needs to hear or should have heard.
Well, one thing I've realized a lot in the last few years, Andy, and it's one of these things that even when I think I fully estimate its value, I then find that I continue to underestimate its value, if that makes sense how I've described it,
Mm.
is it's the value of relationships. And I don't necessarily mean like the value of your loved ones, because that is very valuable, but I feel like the average 20-year-old, they love their family. Like, they have loved ones. I'm just talking about the random people who you meet throughout life and the impressions that you make or don't make on those people, and how those impressions can come back around in the long run and provide either something bountiful to your life, or sometimes can provide something negative to your life if it wasn't a good impression. But I am continually surprised by the random interaction I had with someone when I was 23, and then, oh, lo and behold, they work across the street from me, and I need to ask a favor of someone who works over there, and I know a person because I met them 8 years ago. Or, I mean, one of my favorite ones is, long story short, I played this random racket sport in college called squash. Not many
Mm.
people have heard of squash, but I played squash in college. Young guy, I'm like 24, 25 at the time, and I'm giving squash lessons here in town for side money as a side hustle. And I give lessons to these two really delightful teenage girls who are trying to learn the sport. I meet their dad, super nice guy. Fast forward 8 years, I'm switching careers out of engineering, and I have an interview. And I mentioned to the man who's interviewing me that, yep, I played squash in college. And he goes, oh, my buddy's daughters play squash. Yep. He's best friends with this dad, who I made a really good impression on 8 years ago because I played squash with his daughters. That impression paid dividends. I'm sure it contributed to me getting this job. So I would tell 20-year-olds listening to this, take advantage of the relationships, make good impressions, meet people, build your network, do all that stuff, because you never know what's going to happen in the long run.
Yeah, I think that's great advice. And it's never been easier. I mean, how we met is Twitter. Like,
Exactly.
you can literally use the
Exactly.
internet and social media and find cool people you can chat about interesting topics with.
Right. And you could do this. You can
Hmm.
you can meet in person when you just
Hmm.
happen to be in Austin, Texas. You can go
That's
out,
right.
buy each other beers.
That's right.
Lots of fun stuff can happen.
Very cool. Well, Jesse, I very much appreciate your time. This was a very fun conversation through all kinds of investing and finance topics. If anybody wants to follow Jesse, I'm going to make it real easy for you. Down in the description of this video, I'll leave all the links to all of Jesse's stuff. You should definitely read his blog. You should definitely listen to his podcast. You should follow him on Twitter. Thank you very much, Jesse, for being here.
Thank you, Andy. This was a lot of fun. I appreciate it.